Welcome. Hi. So, okay. Welcome to our live stream. Today, Ventures together with Nordea. We will have an introduction to startup financing, and we will have an introduction to both debt financing and equity financing. And in the end, we will have a Q&A, so please comment your questions in the chat box. And if you want to get in touch with Nordea Startup and Growth or Nordea at Work or with Ventures, you can find information below. So I hand over to Victor from Ventures, and we see you later.
Thank you, Clara. Good morning, everyone. My name is Victor Hjellström. I am a co-founder here at Ventures and also an investment manager. And today I'm gonna take you through a little bit about equity financing together with Axel from Nordea. Before we go into that, I just want to give a brief introduction to Ventures. So we are a one-stop tech and business partner, basically a digital consulting company that also invests in seed rounds in tech startups here in Stockholm and Sweden, basically. We founded this company 4 years ago with the vision to actually help entrepreneurs realize their dreams and build successful digital businesses. We have a business model where we are open to reinvesting our fee in the people and the businesses that we believe in, and in that way become shareholders and equity owners in the businesses. And today we have a portfolio of around 20 early stage tech companies here in Sweden, and we're about 30 people working from our offices at Kungsholmen. Our sort of offering consists of everything from strategy and concepts, which you can see on the slide here, UI UX design, building of MVPs and beta versions of digital products, more long-term product development and programming, and then we help you launch and grow your business, as well as our sort of investment and sweat equity setup that I can talk a little bit more about later. And with that, I want to hand it over to Jakob.
Hi everyone, thank you Ventures for having us, and I'm very happy to be here today to talk. Before I hand over to my colleague Axel, I just want to quickly cover what I do and my department. And Axel will talk to you later a little more about debt financing. So my name is Jakob Amelon, and I work for a private branch office in Nordea that we call Nordea at Work, that I run together with a few colleagues of mine. And we specialize on helping our business clients, the owners, founders, and the key people of the companies, but we help out on the personal financing part of the finances. So we have the opportunity to sit very close to for example, Axel and his team on Nordea Startup and Growth, and also other relationship managers on our business side, and we focus on helping those clients out with the personal financing simply. So we have the opportunity to be a full service bank, where we're able to help you guys out with everything from loans and credits and housing loans to savings and investments and insurances and much more. And as an entrepreneur and running a startup, it's very easy to go all in with your company, which is usually a good thing, but it also is very easy to forget about your personal finances in that process. And that's why we want to be there to help you guys out with that as well. So that's why we work very closely with, for example, Startup and Growth to make sure that we can be there from from the beginning for you guys to and help you out with your personal financing and make sure everything is set up for you guys there for now and for later in life. So please, if you have any questions for me or if you want to get in contact with me, please don't hesitate to contact us. You can find all the contact information down below. So with that, I want to hand over to Axel.
Thank you, Jacob. My name is Axel Bruselius, and I run something called Startup and Growth in Nordea. Startup and Growth is essentially a bank within the bank aiming exclusively at fast-growing tech companies. So when we meet entrepreneurs, we find that they have very low expectations on what a bank can do for them. They don't really see banks as a partner. We believe that's due to the sort of traditional banking model where you have startups mixed in with anything from hairdressers to carpenters to restaurants in a regular banking concept that also scales with turnover. This works great if you have a sort of linear traditional business, but we see that with startups, you may need to have quite advanced products, coaching, and quite difficult questions early on. So that's why we've built a banking concept that focuses exclusively on tech companies. We have experienced advisors that work also sort of sector specialized, be it in digital health, in entertainment, gaming, or in fintech. We also open up our networks and product specialists very early on, be it in payments or foreign exchange. And what I'm here to talk about today is that we also try to offer financing for startups and scale-ups. And on the right you can see some of the companies we work with, but we work with about 400 fast-growing tech companies in Sweden, from some type of proof of concept, like getting your product out in the market or raising equity, up until some of Sweden's largest tech companies. So, debt financing, and I should say this is quite a complex area that I'm going to try to go through in about 15 minutes. So if you do have questions, please just write them in the chat box and we'll try to address them after the talk. So, traditionally, banks' financing models are built for things with hard assets like factories or real estate. And this is what a scoring model in a bank could typically look at. You look at sort of industry risk, you look at what historical financial numbers have been, what's the value of securities in a company. And to be honest, this works very poorly for startups that are probably more focused on growth than profitability, that may see their income triple every year, which means that you're essentially building a new company all the time. And that's why I would say a very small minority of startups today actually have debt financing. We believe that far from all startups can have debt financing. I mean, if you're not going to be profitable for 5 or 6 years, it's going to be hard to repay a loan. But we see more and more tech companies actually striving to be able to raise financing, and we're actually able to debt finance more companies as well. So if you sit down with a bank that actually understands what you're doing, they will be asking 2 questions. Should we finance this company? Are they actually able to repay a loan? And things that you'll look at is, as I said, traditionally you will only have looked at sort of historical financials. What we do in Startup and Growth is we try to look at how far is this company from profitability. Okay, they may be focusing on growth for 2020, but is there a plan to become profitable in 2021? That's sort of the first question. Secondly, if we hear this, we need to understand assumptions behind that. What is the road to profitability? Now, if you've just signed a few big contracts that are going to give you economies of scale, and we can see that gives us a lot more confidence than if you're going to launch an app and you're hoping for a good take-up, for instance. And that sort of helps us determine certainty of predictions. And then we talk a lot about emergency levers. So we see some companies that are just far from profitability because their growth journey hasn't come far enough yet. We see other companies that are sort of in a self-chosen unprofitability. Examples of this can be that you have a profitable core business, but you're focusing a lot on product development, customer acquisition. And if you can highlight those questions to a bank, that can help with a loan as well, because then we can see, okay, if things go south, you can probably cut those costs and achieve profitability again. Now the second question is, once we think that there is a good credit risk in a company, we're also, as are all banks, bound by a regulation, and in the Swedish case by the Swedish FSA, and they make each bank have their scoring model where you need to fit into a certain model for the bank to be allowed to lend. And so your company also needs to be fit into this model, and that is based essentially on two parts. So it's based on current and future income. You can use the model on income for the coming year, for instance. And it's also built on the strength of your balance sheet. So basically, what's your equity to asset ratio? And this is quite good to think about when you're building your company. You may not be thinking about stuff like capitalizing your development costs, or how you're counting equity, or sort of if you bring in investor money in terms of loans or as equity. This can make a huge difference for a bank's ability to fund you. Also, company's age plays a minor role, so it's actually quite good to start your company as early as possible to sort of fit into a framework. So moving on, you sort of know what boxes you need to tick to be able to raise that debt financing. What can you actually do as an entrepreneur or a startup CEO to meet this? I think one of the things we've been seeing in this past year is companies really adapting their business to their desired funding. Victor will talk a lot more about raising equity, and I think if you want to raise a successful Series A round, for instance, you probably need to show really fast growth. Now, if you feel that the valuations aren't quite right for you, or you don't want to get more diluted and want to raise bank debt instead, you may actually want to slow the funding, the growth journey for a year or two to be able to be more profitable and bring in bank debt. And we see a lot of sort of very large startups that have gamed that journey. They've been sort of relying on bank funding for some time, then there is equity for growth, then they go back to bank financing. So see it as that you can actually steer your growth journey to achieve the financing you need. A second thing is, we know that all successful startups are very good with their data, and you can actually use that when raising debt financing as well. Oftentimes we see someone simply presenting us with an income statement and a balance sheet, but actually showing, for instance, if you're a SaaS company, showing your CAC to LTV metrics can actually help in a bank discussion as well. So really help someone understand your company. Then there may be, for certain types of startups, there may also be structures in your contracts that allow you to lend. We see a lot of companies that are building business-to-business applications, for instance, and then they end up raising equity because they need to be able to service a very large order. They need to tailor their product to an order. Now, if you're able to make that order and the contract for that strong enough, that may also be basis of lending. Your company may not have been sort of very bankable earlier on, but you may be able to raise debt on the back of that order. And lastly, we also see that how you legally structure your business can be another opportunity to lend. This again is sort of a special case, but we see some companies where they have a sort of a growth engine or a tech platform that is sort of very expensive to build and maintain, that may be hard to fund banking side, but fund with bank debt. But then they have another side of the business which is more traditional and is fueled by the tech platform. If you structure it right legally, you may be able to lend to that more profitable part. So don't necessarily see your company as one sort of immutable entity. Now, if we look through the different types of funding available in the whole ecosystem, almost all companies that we come across have started with loans from the Swedish government lender Almi. Those are traditional loans that need to be repaid, but the criteria for getting them are often a lot softer. So it's a good place to start. And Almi has recently received a lot more funding as well to help with the corona crisis. I would definitely talk to them. Then if you look at regular bank debt, it can basically be structured into three parts. So we talk about working capital, which is essentially about funding, your daily business, invoices, capital needs that arise when you sell stuff. That can be structured into an overdraft account, which is a loan that you can increase and decrease the amounts according to needs. That is about the same difficulty to get as a regular bank loan. Then we talk about factoring. So this is something that a lot of companies can use if they're not that strong financially. And that means essentially you take up debt that's secured against the money that's due to you from other businesses. So if I make a huge sale to H&M, for instance, and they're not going to pay me for 60 days, then I can lend against that to cover the costs I have for that order. And then we see certain cases where we can tie financing to certain accounts where payments are due, which we use if the company is deemed risky. Then we have regular loans, which are used to finance sort of growth initiatives or investments. And then we have bridge funding, which we see a few banks doing. And that can be based on if you have an investor commitment, but you haven't been able to close your round yet, there are a few actors that will actually lend you money for a short period of time so you can bring in the rest of your investors and close the round. Then if we move away from what traditional banks do, we see a lot of convertibles and owner loans now. That can be helpful to use if, for instance, you haven't been able to set the valuation of your company, but you know that people want to invest. You can do a convertible, and then that changes into equity once you raise. We also see more and more companies doing venture debt. That is debt that is typically not issued by a bank, but from a fund instead, which has a lot higher interests than what we at Nordea would offer. It also often has some sort of warrant, something that converts into equity along the road. But it can be a good alternative for larger fund financing if you don't want to get diluted. And then, of course, the most common source of funding is equity, which Victor will talk more about. And hope to be able to answer some of your questions in the Q&A. But also, please don't hesitate to reach out. Here are some contacts to me and my team. Thanks.
Thanks a lot, Axel. Great introduction to debt financing. And I will be moving on, talking more about equity financing now and how that works and how the ecosystem here in Sweden at least look like at the moment. So you know, starting a business is not an easy thing, and everyone hopes for bringing home the big bucks straight away. In this graph you see here on the slide, you see the ideal sort of relation between your company size and the valuation of your company and the time and the stage your company is sort of in. And even though this would be a very simple and easy way to go, we all know that in reality it looks something like this at best. So that's the first sort of advice for all you entrepreneurs out there and people thinking about starting a startup. It's gonna be a rough path that is it's gonna take a lot of hard work. Nevertheless, I want to take you through the sort of different stages of a company in regards to equity financing. Just mentioning quickly where sort of what stage your company should be in to be able to take in these kind of investors and this kind of funding, which some of the relevant players are, and also what kind of valuation and ticket sizes of investments you can actually expect in these different phases. So if we start with sort of the founding of the company, so maybe you and a business partner, you've got a great idea, you've sort of started sketching on this, and you have some potential customers you've been talking to. You know that there is some sort of need existing there. You are solving some kind of problem, but it's still quite undefined. What you do is you break your piggy bank, which you can see here on the picture. You take all the money you've ever earned and put it into the company. Maybe a few $100,000 or even less, sometimes more. Some recommendations here are to actually speak to one of our partner companies, Antler, which offers a financing of your initial 3 to 6 months as an entrepreneur, where you can even go in without having your idea set in stone, just to meet your co-founders and team. So that's a good way to go. You can also speak to the Swedish governmentally backed investors, which are Tillväxtverket and Vinnova, that even give out, you know, soft equity, soft money that you don't need to give away shares from. So I would definitely talk to these players, except for all the debt players that Axel was talking about, just as Almi loans, etc. And at this stage, you can expect a company valuation somewhere between maybe 3 and 10 million SEK, you know, no more than 1 million euro basically. And the normal sort of investment ticket sizes here, when you yourself or, you know, your friends and family or other people invest, are normally not more than 1 or 2 million, you know. So that's the first kind of stage. Moving on to what we call the pre-seed phase, when your company has grown a little bit, maybe you've started to get a product out on the market that is at least a beta or an MVP, like we call it, minimum viable product. You maybe have your first customers on board. You have, you know, hopefully gotten a few crowns of revenue in the company. Then maybe it's time to bring on business angels, which are I'd say the major investor type in these stages. So business angels that have you know, wealthy individuals which have maybe expertise from the domain you're working in, together with actually Sweden's most active investor in tech startups, which is Almi Invest, is often a good combination at this stage. There is also a player called Sting, which runs an accelerator program, which I would recommend, where you also can get more advice and a context for your startup in early days. This is also the phase where we at Ventures come in. So normally we team up with the entrepreneurs, we bring resources and knowledge to the team, and help the entrepreneurs get through this phase, which can be a bit tough sometimes, before you really have proven your value and sort of that the company is stable. And here it's really important to find the right partners. Normally valuations in this stage are around, you know, 10 to 25 million SEK. It can be less, it can be more. But that's, I would say, an average of where we see valuations when we do investments in these kind of companies. And normally these funding rounds are around, you know, from 2 to 5 million SEK, I would say normally. So depending, and then often it's a few, you know, 3-4 different investors that contribute to this. Moving on to the seed phase. So and here, I mean, the definitions differ a lot. So in Sweden, for example, what can be a seed investment round here in Silicon Valley or in other parts of the world could be, you know, just a sort of a pre-seed or a initial investment. So it differs a lot. But here in Sweden, I would say that when you come to this stage, you have a product that can scale, you have something that can grow, you started to get a more de-risked customer base with several customers. You see that the customer base is growing, and you're basically ready to take in more capital to boost this growth. And here the early stage venture capital funds are starting to be interested in your company. We have players such as Inventure, Luminar Ventures, Brightly Ventures, also Norrsken in Cloud Capital, which I've mentioned as examples here, are players that could be good to talk to when it comes to these kind of stages. Here I would say that normally the valuations range between 25 to 75 million SEK. and normal ticket sizes are from 5 to 15 million SEK. So basically, it's a 20% ish dilution that we're talking about. So when you bring in money at this stage, you have to give away approximately 20% of your company. Moving on to sort of the big league of venture capital and this kind of startup, no longer startup maybe at this stage, but more scale up equity financing. So we call these stages Series A, Series B, C, D. You can go on forever, but at this stage you have a well proven, oftentimes international product or service that you have shown can be exported to other countries. You probably have a monthly recurring revenue of at least 1 million SEK. So here at this stage, your company is actually bringing in quite a lot of revenue. I would say maybe sometimes it's even 10 million SEK or 100 million SEK in monthly revenue. So this is a proper company, quite big. I would say that normally you'd have a team of from 20 to many hundreds of people here. So and here the bigger sort of VCs that do larger round here in the Nordics are, for example, Creandum and the North Zone. We have a player called Alf Didriksson, which is not actually a venture capital fund, but more of an evergreen fund, which I think is good in many ways. And EQT Ventures, for example, is another player which interested in investing in these kind of stages. And here the valuations can go from around 75 million up to several billion. So this is very, very hard to say. Here are where we're gonna find some of the unicorns of the world. So and ticket sizes here also can be many hundred millions of SEK invested. So this is sort of the last rounds of financing that you ever need to do to reach to your exit or not. Doing an exit is a dream for many entrepreneurs. Managing to build something that's so valuable that it can be sold, but that I would say that think twice if that's what you want to do, or if you want to build a successful company which can be a very profitable company that you can own for a long time and generate cash for you, basically, in dividends. And to make it to this stage, now we're no longer talking about funding, but this is just sort of the end game. Then it's really hard to, in regards to product and customers, what should you reach? Like I've written here, a product and or customer that someone wants. That's what's gonna make it possible to do an exit. So it can be either to a trade sale to a competitor, to a major larger player in the industry you're working with. Many of these venture capital firms, they aim to put your company on the stock market, doing an exit that way. And here also the valuations can differ a lot. It can be anything from pre-seed money evaluations up to several billions. So what do I want to say with all this? Some final tips for you about what to consider when bringing on an equity investor, I would say, is think about the investor you're bringing on. Are they familiar with the industry that you're working in? Do they have the expertise that you need to make the right decisions in your domain? I think that's a really interesting thing, often neglected. Do they have the right kind of network with the connections you need to be able to open the doors that you want to get into. Also very important, coming back to this, with the exit strategy and ownership, sort of directives and strategy. Do they have an aligned vision and strategy regarding that or not? That I think is very important. Can they keep backing you? An investor that have deep pockets and that can help you through your full journey is often a good thing and shows strength outwards in coming rounds. And then of course, do they have the resources and the knowledge that you need in the stage you are in right now? And especially the last bullet is where we at Ventures come in. So we don't invest with cash, we invest with sweat equity, which is that we basically give you our resources, our knowledge. We can help you build the product and help you in that way. So that's some final words from me, and I think let's move on to Q&A.
Okay.
Jump back in here.
Yeah, welcome, Axel.
Thank you.
So we got some questions here in the chat box. We can start with Amanda's question. What would you say are the most important factors that investors look at in early stage financing?
I think that when it comes to early stages, and then going back to this slide that I had, if we talk pre-seed, seed maybe, I think that the one single factor that's most important is the team. So basically they will look at the people in the business, you and your co-founders. Are these people that they trust in? Because it's a big decision to put all that money in someone's hands. So I would say that the team is the single largest factor.
Thank you. And the next question is from Isaac here. Do certain types of financing work better for specific tech industries?
So I guess if we look at that financing, I would say yes. If we look at our portfolio, we have loans to maybe 40% of our customers. I would say that quite a few of those are in the business-to-business SaaS or software as a service industry. That's because there you see sort of stable revenues that you can sort of see are sticky for a long time. And I think anything that emulates that, you could see the same dynamics in consumer businesses as well. If you have a subscriber base, if you're not profitable, it's a lot easier to finance that type of business than you would if you're dependent on constantly sort of selling your income statement every month.
Thank you. And the next one is from Joachimson, and he's telling us, thanks for a good presentation. Thank you very much. What companies would you say are better fit for crowdfunding, and when shall I not consider crowdfunding as a good founding option?
Is he referring to crowdfunding maybe? Yeah, crowdfunding, exactly. So I mean, crowdfunding it can be done both with debt and equity. I think it's a concept referring to when you actually reach out to a larger investor base, and there are certain platforms for doing that. I would say that that's a good financing form when you have a product that a lot of people can be interested in, like consumers, and that is have this kind of word of mouth effect that can quickly spread, because then you can get a large investor base with smaller tickets in.
nu att få höra klart.
Där, nu har vi ljud igen.
Okay, perfect.
So we're back.
Great. Just some technical problems with the sound there.
Claire, do you know if we got through the crowdfunding question with sound?
What do you say? Did we?
Yeah,
What do you say, Joachimsson? Did you get your answer?
Did you hear the response?
Honestly, I think from what I could tell, I would say try to go through that question again.
Okay.
Okay.
So
The crowdfunding question, is crowdfunding a good alternative for financing? And what I said was that for businesses and products that are facing consumers and that will benefit from this sort of ambassadorship and word of mouth effects, crowdsourcing can be a really good alternative. And then you get a larger investor base using different crowdfunding platforms to reach these investors, which can be private persons investing with smaller tickets. So that's a really good thing in some cases. And what I said, what to be cautious about and bear in mind is that you will get a very big, large investor base with a lot of different investors, which can be sometimes administratively heavy. But there are ways to handle that as well. I think you wanted to add something there, Axel.
No, just agree on the if you're doing equity crowdfunding, it can partly be administratively tough. It can also sort of scare away some investors that see that it's hard to get that share base to agree on agreements. But I think if you're talking about sort of product crowdfunding like Kickstarter, we see a few Swedish companies that have done that really successfully, like Asket or Flick, or now I think Mendy is breaking records now. So that can be a good way to go.
Yeah. Yes. Next question is from Jose, and he's asking, what industry sectors do you find exciting for the next 3 years, both from resources that ventures could contribute to and financing hype?
So, I mean, what I see, you can also give your answer, but what I see is that sectors such as insurance tech and med tech, I think are really hot right now. We see a lot of interesting companies in these sectors. I mean, especially now during this COVID-19 crisis, we see the demand for digital healthcare solutions rising. So that is a very interesting sector for us. And on the second part of that question, what ventures can help with. So we basically work sector agnostic, but our core focus is always digital products. So sector-wise, we don't have a deep expertise, and it doesn't really matter that much to us. But yeah, that's what I would say. I don't know what you say, Axel.
No, I agree. What we do see as well is sort of even deeper niches. So if you take the healthcare parable, it's getting quite expensive to reach consumers in sort of general practitioner health. So you see, and at the same time you see sort of industry actors getting more and more sophisticated at working with startups. And this means that you dive a lot deeper into each industry. So in healthcare that could be, digitalizing lab tests or sort of patient information. And you see that across industries, that's going deeper in your startup.
Yes. And we got some other questions by email, so we can go through them as well. The first one, how do I get in contact with the right investors? It's always tricky to get through the right doors and get the right meetings with the right kind of investor. But I would just say it's a numbers game. Reach out to in your network to whoever you know that might know someone. It's always good to have a warm intro to someone, because obviously most of these investors are quite they have a lot of different proposals on the desk.
That said, I think if you have a really good idea and a good pitch, just email it straight away to their contact info at websites or application forms, and they will look at it.
Okay, good, thank you. And maybe you can this one. How do the new government guarantees?
Oh yeah, I guess that's on the new sort of banking guarantee. So as a response to COVID-19, the Swedish government and most European governments are offering support and guarantee to the banking system. So in Sweden, the one that was most written about was loans from the Swedish Riksbank to banks. I think that one may not present sort of opportunities for startup funding in itself, but it does sort of ensure that the banking system is sufficiently strong to continue lending. Now, a good thing I think in the Nordics is that the banks were quite strong before the crisis hit. But then you've seen a few more targeted schemes that sort of take away a bit of a bank's risk if it lends to a company. So this is something that banks will be using and could help them actually do lending to your company. The Swedish programs so far are not really that targeted towards startups, so we haven't seen a major change yet. But if you look at companies like Denmark, France or the UK, there are very specific startup guarantee programs from the government that really helps banks lend to startups. So we're hoping for something similar in Sweden.
Cool.
Okay, and we got one more questions here in the chat box. I think I need help with this.
IoT funding for demonstration facilities, is that even possible? So I assume that the question regards to getting funding for like showcasing a prototype of a IoT, which is Internet of Things, sort of. It can be a connected home or whatever. My answer to that would be that if you have a business plan which shows commercial potential, and the first step in that plan is to actually build a demo sort of showcase of your IoT application, I definitely think that could be funded by at least by equity investors. I don't know what you say.
Yeah, I would say for bank funding, if it's on a sort of prototype state, if you actually want to test if the product works, it's the sort of risk reward is a bit loop-sided. It could become very valuable if it works, but there's also quite a high risk of it not working, which makes it difficult for bank funding. One thing I would recommend in the whole AI space as well is to look into soft money or government funding. We know that the EU's Horizon 2020 program, for instance, has a lot of money that they give in grants to anything that is AI related right now.
Thank you. And some more here by email asking how does ventures investment model works?
So basically ventures, we invest cash in share issues as any other investor. The difference here is that these cash cannot be used to a lot of other stuff except for buying services from ventures. So that's, in a way, we don't invest cash. We invest with resources and knowledge that we have. But technically, yes, we are cash investors in share issues as any other investor.
Good. And what do you say? What does
a bank loan cost?
Oh, that's a good question.
It is a good question. I think in general, if you can get funding from an actual bank, it's probably the sort of cheapest funding source you can get. Then you need to be certain you can repay it. But it goes back to this rating model that I was talking a little bit about. But depending on where your company ends up on a risk scale, I would say anywhere between maybe 2 and 6 or 7%. But then there's really no strings attached. It doesn't take a share out of your company. Then if you move up to other funding sources like Almi, I think that can range up to maybe 8%. And if you go into some of the funds that do debt financing, like venture debt, that can range into the high teens, so 15-20% in cost.
Okay, I think we have time for, we have 2 more questions here. And if you want to, if you have more questions, you can just ask them now in the chat box as well. And okay, so how should I build a good pitch?
Good pitch. So I think this is also an interesting question. I want to hear your answer on how you do with pitches when it comes to debt financing. But for equity financing, I think that a good pitch should be quite short, maybe a 10-slide pack, basically showing the problem and your solution to that problem, the sort of business model of the company. How are you going to make business out of this? Your plan to launch and grow this business, because you can have a great product, but if you don't know how to sell it or go to the market, no one's going to find it. I would include bios on the team, because as I said earlier, the team is the single most important factor for taking investment decisions. So a lot of information and background on who you are, and then also sort of the investment opportunity, the ask. How much money are you raising? What valuation are you expecting? What are you going to use the money for?
Thank you. And now we have 1 question left. Do I need to offer a personal guarantee for a loan?
I would say that is probably expectation from a lot of startup funders when meeting a bank. And I would say if whoever is offering the loan doesn't really understand what you're doing or believes that the company risk is too high, then they will demand a personal guarantee. But in my opinion, that's not necessarily a loan to the company. It's more of an extension of a loan to yourself, but through the company. So I think it's not necessary. If you manage to sort of convince someone of the repayment potential in your company, at least for the vast majority of the loan amount, there won't need to be a personal guarantee. Then we know that some banks also want some sort of personal guarantee to make sure that the founders are aligned with the bank in the risk profile, but it's not necessary.
Okay, we just got 1 more question here from Jose that we talked with before. He's saying, very interesting model, but I'm curious, what's Venture's revenue model? Is it from clients and dividends from portfolio companies?
So we at Ventures, we have a more traditional digital agency and IT consulting part as well. And it's actually the revenues from that business that finance our investments into technology startups.
And yes, if you want to get in contact with us, you can just send an email to us and we will answer you as well. So I think that was all questions for now.
Great.
Yes.
Okay.
Great.
Thanks a lot.
Yeah, and thanks for all the interesting questions as well.
Yeah. Thank you, Axel,
Thank
for
you,
coming
Victor.
here, and thanks, Clara.
Thank you very
Yeah.
much.
Take care.
Take care. Bye.
Bye.